And welcome back to another Econ Podcast with Mr. Hagan. On this Econ Podcast, we're going to continue to talk about investing. Please remember this video is not designed to give investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, so in a previous video, we talked about the random walk theory and the idea of the trade-off between risk and return. Trade-off between risk and return. From a random walk point of view, the only way really ultimately to get a higher rate of return, this big return down here where you got an 11.7% return, that was right here in small company stocks. The only way to get that really higher rate of return is to accept more risk, higher standard deviation, greater spread over here on the histogram. Okay. And the only way to reduce risk, the way you can reduce risk, it's not entirely true, but one of the ways of reducing risk is to accept lower rates of return. So you could go in treasury bills and you'll get a lower rate of return, and but it'll be relatively safe. You'll probably end up with less money at the end, but it'll be safer. You won't have as many ups and downs. So you have a lower rate of return right here. You'll have a much lower standard deviation, and you will have lower distribution or lower spread distribution on the histogram. So there's this inherent trade-off between safe and a lower rate of return and accepting more risk and a higher rate of return. That's the idea. And I want to talk about this just a little bit more because I want to talk about it with reference to a very important concept, which is what we call asset allocation. Okay, so asset allocation, very important when you start building a portfolio. And your asset allocation is really comes down to what percent of your portfolio do you want to have in bonds. Bonds, not always, but in general, bonds tend to be safer, but you get a lower return, okay, which is consistent with what we were saying earlier, lower return, okay? Or what percentage of your investments do you want to have in stocks, which tend to be riskier? You're going to be taking more risk, but you're going to tend to get a higher rate of return. You're going to tend to get a higher rate of return. So these are those trade-offs that I was just talking about. So then you want to think about what percentage of your portfolio do you want to have in bonds and what percentage do you want to have in stocks. So this is a very helpful chart when you begin to think about this. What this chart does is says this looks at data from 1926 to 2013. I got this chart from my source is myjourneytomillions.com, and it looks at data from 1926 to 2013. And these are different mixtures of stocks and bonds and what they actually did, what those returns actually were over these time periods. So the way we look at it is this. Let's look at this portfolio right here. This portfolio was 100% bonds. That was right here. This portfolio was 100% bonds. So from 1926 to 2013, during that time, the average return on a portfolio that was invested in all bonds was 5.5% per year. That was this number right here, 5.5% per year, which, by the way, is pretty close to what we talked about over here with government bonds of a rate of return of 5.7%. Okay, very consistent with that. What type of risk? Well, now we're looking at risk in yet another way. The worst year from 1926 to 2013, the worst year of a 100% bond portfolio was losing 8.1%. That was the worst year. The best year was gained 32.6%. So again, we can think of this spread from top to bottom as your risk. We can think of that as your risk, that there will be And so this risk is relatively small. There was a year where you had as high as a 32% return. There was a year that you were as low as negative 8.1 return. But the difference between those relatively small, with an average of 5.5%. Okay, what if we add some more stocks and reduced our bonds in our portfolio? So if we look at this example right here, this is a 50-50. That is to say, now you have this portfolio has 50% of it is in stocks and the other 50% is in bonds. So what did that portfolio do? Well, that portfolio had an average return of 8.3%. Okay, so that's a higher rate of return. Over here, 100% bonds, you had a 5.5% average rate of return. Okay, you had a lower rate of return, but also lower risk. Your spread was not as great. Okay, but if you were 50% stock, 50% bonds, your best year was 32.3%. Okay, but your worst year was negative 22.5. So from top to bottom, from here down to the bottom, you had a greater spread. You had a greater risk right here. Greater spread, greater risk. So with a 50-50 portfolio, 50% stock, 50% bonds, you had an 8.3% rate of return per year. You got a much higher rate of return. However, you also took more risk. You were going to have some years where you lost 22% of your money. Over here in 100% bonds, you never had a year that you lost 22% of your money. Okay? And then let's go to the other extreme, 100% stock. If you were 100% stock, then your average rate of return, not 5.5%, not 8.3%, but 10.2% rate of return per year. 10.2% rate of return per year. So you got a much higher rate of return. However, your worst year was you lost 43%. And your best year was you gained 54%. So again, the risk from top to bottom, sorry about that, the risk from top to bottom, okay, from your best year to your worst year was a very big spread, okay, much bigger spread than what we saw over here in 100% bonds. So 100% stock, you had a year where you lost 43% of your money. So, can you take that? Can you live with that risk in order to get this higher rate of return in the long run? Or do you prefer 100% bonds where you get a lower rate of return but lower risk, and your worst years you lost 8.1%? Or all these combinations in between, right? So this might be like 90% stock, 80% stock, 70% stock, 60% stock, and so forth. And each one of them historically have different rates of return and different levels of risk. So, okay, so again, this is the idea of asset allocation in terms of stocks and bonds. What combination, what percent of stocks and bonds do you want to be in? And then what are the rates of return and the risk associated with those different asset allocations? Okay. As most people will argue this, most financial advisors will argue this, that you would want to be in more stock. You want to be over towards this end when you're young. Okay. Why? Because you have more time. You have time to get these higher rates of return. Okay. You have a long time until you retire, so you can put up with these bear markets. Okay, you can put up with these low some years where you have really low rates of return, and you just don't worry about it. You just hang in there for the long run. That would be the argument. Okay, but when you're older, then the argument is that you want to be more over here, more in bonds, because you're getting close to retirement, and you don't want to have one of these, big declines in your portfolio right before you retire. So essentially during your lifetime, this is the typical recommendation, is you start over here when you're young, and then you move this direction towards more bonds as you get older. Okay, those are generally kind of the recommendations. Okay, so that's asset allocation and the connection to risk and return. Again, over here, more stock means more risk, but higher rate of return. Okay, more bonds means less risk, but lower rates of return. That's the general trade-off. Okay, so this has been Mr. Hagan on another Econ podcast talking about asset allocation. Thanks for joining me, and we'll see you on the next podcast.